the S&P 500 moving into positive territory for the year so far, 2016, despite that crazy volatile beginning of the year. Remember, it was the worst beginning of the year for any year for the market, and there was all that panic. Well, here we are. The uncertainty had investors searching for yield. They are turning to dividend payers. And my next guest just won an award for most innovative new ETF. The fund coming to market just last summer. Joining me right now is Pacer ETF Distributors President Sean O'Hara. Sean, good to see you.
Thanks, Marie.
Thanks so much for joining us. Yeah, so we got a market that seems to look a little firmer this morning. Where are you seeing the flows in terms of money moving into certain sectors?
Well, I think the flow is really to high-quality, large cap and dividend payers. It's not into speculative stuff, no emerging market flow, although we did have a meeting with some folks yesterday that said that's starting to turn a little bit. But I think, we're 7 years into a bull market here, right? And at some point that's going to change. So I think we have to start being realistic about the way things work. And you can't, I don't know if you want to buy the whole market anymore. I think you're buying names that are not necessarily working very well. So if we have to another year before we would set the record for the longest bull market ever. So I think it makes sense today to start to position yourself for a little bit of protection or a little bit more high quality. We're big believers in dividends. We just launched a dividend ETF that has about a 4.4% dividend yield. And in this environment, the American retiree is really getting crushed.
Yeah, for sure.
Next to zero interest rates, they work at the greatest generation, or the back end of the greatest generation, again, is paying the price, if you will.
And no surprise that you've got interest in dividend payers when you got interest rates at rock bottom levels. Where else are you going to get the yield?
Absolutely. You need it, and you need a packaged product to get it for a lot of people. But, Sean, I was wondering, you hear all this talk about fees and how fees are too high, fees in mutual funds are too high, fees in ETFs are too high. Seems like the entire industry is kind of in a race to zero. Can you speak to that as you are launching this product? Are you concerned that there's going to be a new technology out where everything is free? Because you're seeing that pop up in the industry.
Well, what is the old line that cost is only an issue in the absence of value? So
I like it.
If you have a large cap benchmark ETF like the S&P 500 where there's not a lot of value add, it goes up exactly what the market goes up and it goes down exactly what the market goes down, then that has a value in the market. If you have stuff like what we think we build, for example, that adds excess return or does things that are very specific in terms of providing protection on the downside, then I think there's value in that, and I think you can have a fee for that, and I think people will pay for that.
One of your main ETFs, which it market times essentially, like you shift stocks to bonds and back again, it's actually down about 5.5% year to date when long-term bonds are up and stocks are up. So why is it down if it's supposed to add protection?
Well, because it's not supposed to market time. So
okay, but it shifts allocations.
We think it's risk management. So we use a simple moving average, a 200-day simple moving average, which people have been using for a long time as a way to gauge what the trend is in the market. There hasn't really been any trend. It's been very choppy, and during that kind of a period, you'd expect a little bit of underperformance or choppiness in your returns. But as I mentioned earlier, Dagan, we are 7 years into this bull market, and sooner or later it's going to roll over, and when it rolls over, I'll come back here and I'll brag vociferously about my performance versus my benchmark when the market's down 30 and we're down 5. So, when you're a long-term investor, we're not market timers as ETF manufacturers. We're building product. We always look at the end customer in mind and what is the need that we think we can solve for that person. In that ETF, PTLC, we think we're providing some downside protection. In PGHD, which we just launched as a dividend pair, we think we're providing value for people who want a yield on their investments because they can't find it anywhere else.
And that's obviously been the story of the market, no yield. Real quick, do you buy into this rally in oil? $42 a barrel this morning.
There's a part of me that's hoping that we go higher because I think that they had the J.P. Morgan announcement earlier today, and there was a little discussion off air about are there revenues up? Is it But I think
by the way, they were down from a year ago.
If you look at it, I think they're not growing their revenue, but they're at risk. There's a big chunk of the financial services sector that's at risk with energy loans, and so I'm hoping that oil prices continue to move up, maybe not to $100 a barrel, but at some level, so that doesn't become a bigger problem.
Yeah, that's one of the stories in the money investing section, that's for sure. Today, oil loans burden banks. Yeah. Sean, it's great to see you today.
Thank you so much for having us.
Thank you. Congrats on the award. And Sean O'Hara is the president of Pacer ETF Distributors. Still